Welcome to this first quick answers tutorial covering the executive compensation 457B plan for tax-exempt co-ops and presented by the Homestead Fund's Deferred Compensation Consulting Team. This video will introduce you to the basic features of the 457B plan and help you determine if such a plan might be right for your co-op. We'll walk through the following topics. What is an executive compensation 457B plan? Why might your co-op consider establishing such a plan? How are these plans established and then administered? Who is eligible to participate in these plans? And then finally, where to go to find additional resources from Homestead funds to help you learn more about these plans. So just what is an executive compensation 457B plan? First of all, it's a tool commonly used by employers to attract, retain, and reward key employees. Currently, more than 250 of NRECA's co-op members provide their executives the option of a 457B plan. The plan provides a supplemental tax-deferred savings option similar to an employer's qualified 401k plan to a select group of senior executives and managers or highly compensated employees. The plan allows these eligible participants to save the maximum amounts each year into both their 401k and 457B plans if they so desire. Contributions can come and are allowed from both the employee and the employer, although employer contributions are completely discretionary. It's important to note one very important difference between the 401k and 457B plans. In a 401k plan, the assets are held in trust for the participants, while assets in a 457B plan, although earmarked for individual participants, are owned by the co-op until benefits are fully paid out. As a result, 457B assets are subject to the claims of co-op creditors, and while not common, a co-op bankruptcy or severe financial distress could mean the loss of some or all of the assets to co-op creditor claims. This additional level of risk is important for all participants to understand. Why do co-ops set up 457B plans? Most do so to address a number of specific issues. If your co-op can answer yes to one or more of the following questions, a 457B plan may be something to consider. Do you have 401k testing issues that limit the amount your senior managers can contribute towards retirement? If you establish a 457B plan, your executives will have a place to defer the funds they are unable to deposit into their 401k due to non-discrimination testing. Similarly, are your senior managers limited in their 401k matching contributions because they earn over the IRS salary limits? If so, because a 457B plan allows for employer and employee contributions, it can be a vehicle for the employer to deposit the portion of the match attributable to the salary over the IRS limit. Do your executives want to save for retirement over and above their 401k maximums, or as we call them, are they super savers? Even if your co-op doesn't have testing issues, a 457B plan provides another vehicle for your senior managers and executives to save on a tax-deferred basis for retirement. Eligible participants can save the maximum into both their 401k and 457B plans each year. Since there are very few other tax-deferred ways to save for retirement, as IRAs, both traditional and Roth, are typically out of reach with their tax benefits for those with higher incomes, a 457B plan can be a nice option to offer your executives and senior managers who wish to beef up their tax-deferred savings. Is your board seeking a way to further supplement your CEO's retirement savings or to defer some compensation into later years? Something like a bonus? A 457B account can be used as a tax-deferred option for depositing additional bonus awards or other CEO compensation. But maximum contribution limits exist for these plans. These limits combine both employee and employer amounts, so any employer contributions will limit the amount able to be contributed by the participant. For example, if a co-op deposited $10,000 in the form of a deferred bonus to a 457B plan and the limit that year was $20,500, that would mean that the participant would only be able to deposit $10,500 for the year. And finally, are your board members interested in deferring taxation on their board fees? Many board members are employed elsewhere and do not necessarily need the income from board membership to meet current expenses. A 457B plan provides them the option to defer this compensation and shelter this income from current year taxation. Board members can defer their board fees and per diems into the plan and then withdraw the funds at retirement or at a later date. It's important to note, however, that directors cannot participate in the employee plan, and a separate plan must be established for this purpose. This is not a difficult thing to accomplish, but it just requires the co-op to have and maintain and administer two separate plans. So as you can see, 457B plans are very versatile and can be used to meet multiple executive compensation needs. Now let's take a look at the key players and their roles in establishing and administering these plans. The most important role is played by your co-op as the plan sponsor and administrator. Unlike the retirement security plan and 401k pension plans, where NRECA handles these functions. While taking on plan sponsor responsibilities may sound daunting, keep in mind that 457B plans typically have only a handful of participants at that, and of course the Homestead Fund's Deferred Compensation Consulting Team is always here to help you. Our consulting team's role is to provide assistance throughout the life of your co-op's plan. We provide assistance in designing a plan or plans to help meet your co-op's objectives. We provide sample documents for plan establishment and administration. And then we offer ongoing administrative consulting assistance to help answer your questions about such topics as participant eligibility, enrollment issues, employee education, employee contributions, employee distributions, and just general ongoing administrative issues. Finally, the third key role is filled by Homestead Funds as the third-party investment firm. While assets are owned by the co-op, most co-op sponsors establish individual investment accounts for the benefit of each participant. As mentioned previously, the assets in these accounts are the co-op's property until distributed to the participant. However, while the co-op controls and owns the accounts can be set up to give the participant the ability to make their own investment decisions. Our Homestead customer service team will assist you in establishing these individual accounts and can also assist your participants with investment management guidance as needed and requested. As mentioned, 457B plan contributions are limited to an annual maximum amount like 401k plans. These maximums are subject to change annually, and unlike 401k plans, include the combined total of employee and employer contributions. Homestead Funds post these limits on the website on an annual basis. 457B plan limits historically have always been the same as the standard 401k deferral amount, excluding any catch-up options. In addition to annual contributions, 457B plans provide for a special catch-up contribution option for participants who haven't maximized their contributions over their plan eligibility period. This special catch-up is available during each of the 3 years prior to, but not including, the year the participant reaches normal retirement age, as designated in the primary pension plan, such as the RS plan. Note that there is no age 50 and older catch-up provision for these plans, as there is for 401k plans and some other types of 457B plans. We cover the details of the special catch-up provision in a separate, very detailed tutorial, and we encourage you to watch that one if you're contemplating using the special catch-up option with one of your participants. Contributions to 457B plans are immediately vested, which means if a participant leaves, they're eligible to receive 100% of the value in the account. For those familiar with other deferred compensation plans that may have vesting dates, this differs in that respect from those plans. Finally, as previously mentioned, all plan assets belong to the co-op, whether they're funded by the participant or funded by the co-op until distributed, subjecting participants to a risk of loss if a co-op encounters financial difficulties. Now let's talk briefly about who is eligible to participate in a 457B plan. There are actually no specific rules or regulations defining eligibility other than the IRS and the plan language stating that the participants must be members of, quote, a select group of managers or highly compensated employees or directors. It's up to your co-op to identify your select group. When selecting your group, consider limiting participation to those who play a direct role in the strategic and/or financial direction of the co-op. Because the board provides such guidance as a rule, all directors are eligible. Typically, most co-ops identify their select group of employees by drawing a line on the organizational chart, as you see here, or identifying specific job titles rather than naming individuals. There's latitude for each co-op as plan sponsor to determine their participation methodology. Because these are non-qualified plans, it's important to truly designate a small and select group and to document this designation and rationale in the plan's administrative procedures and/or employee handbook. For example, this hypothetical co-op has identified 8 positions at the vice president level and above as eligible plan participants. Each of these participants interacts as a member of the senior leadership team and directly engages with the co-op board. The hypothetical co-op has 100 total employees, so this designation seems reasonable, 8 positions. A smaller co-op of, say, 35 employees would likely find it difficult to rationalize a group of this size and might identify only the CEO and 1 or 2 others as participants. As we close this introductory tutorial, if you'd like more information, there are lots of resources on deferred compensation and specifically 457B plans available on the Homestead Fund's website. There you'll find a plan brochure and plan establishment information that includes a step-by-step checklist and plan administration resources such as the employee deferral, distribution, and beneficiary forms. Thanks so much for joining us for this first tutorial on executive compensation 457B plans. If you decide that such a plan is right for your co-op, we encourage you to watch a subsequent tutorial on establishing your 457B plan, as well as the others in this series. And remember, Homestead Fund's deferred compensation consulting team members are here to help. Feel free to send us an email or give us a call. See you next time.